The Securities and Exchange Board of India, or SEBI, has returned the draft red herring prospectus of Oracle Stays, the parent company of hospitality chain Oyo, asking it to submit it again with some updates and revisions. The company, which plans to raise 8,430 crore rupees from the market, had filed the papers in September last year. But now, it seems the recent move will delay the Oyo's IPO by a quarter. But why is Oyo's IPO getting delayed? Why is this famous and promising hospitality chain struggling? Let us start from where it all began. In 2012, Ritesh Agarwal, who was then only 19 years old, founded Oracle Stays for budget accommodations. He had earlier dropped out of college to travel around the country. In 2013, it was renamed Oyo. Soon enough, the startup found high-profile investors like SoftBank, Sequoia India, and Lightspeed Venture Partners. It expanded across Southeast Asia, China, and the US at an impressive speed. After raising $260 million in a round led by SoftBank in 2018, Oyo for the first time revealed its plan to list on the bourses by 2022. By 2019, the startup's valuation had risen to $10 billion. It had over 17,000 employees and had set up 26 training institutes across the country to train people in the hospitality sector. But the finances of the company were, however, shaky. In 2018-19, it recorded a net loss of 2,364 crore rupees, and in the next financial year, in 2019-20, Oyo's losses rose to 13,122 crore rupees. And meanwhile, the pandemic struck. The hospitality sector was among the worst hit. Struggling with losses, the company on January 2020 announced that it would lay off 2,400 employees, which were roughly 20% of its total employees. In October 2021, Oyo filed its draft red herring prospectus with the SEBI to raise 8,430 crore or $1.1 billion. At the time, the company's valuation was $9 billion. It was expected that the listing would take place in 2022. However, due to the pandemic and later the war in Ukraine, the share market had turned highly volatile by the end of FY22. In May, Bloomberg reported that the travel tech firm was planning to shelve its IPO because it could hurt the valuation. In September 2022, the company filed updated papers with SEBI targeting the IPO by early 2023. Meanwhile, its accounts continued to show stress. In FY22, the company's loss widened to 1,940 crore rupees. In the second quarter of FY23, it reported a loss of 333 crore rupees. SoftBank too drastically slashed the internal valuation of the company from $10 to $3.4 billion. In December last year, Oyo announced that it would lay off 600 more employees, mostly in line with other tech giants like Amazon, Meta, and Alphabet. In the same month, SEBI returned its DRHP and asked it to refile it. The situation at the company was a tad better in FY23. In the first half of the year, Oyo's losses narrowed to 747 crore rupees from 801 crore compared to last year. On an yearly basis too, the company's losses narrowed to 1,940 crore rupees in FY22 from 3,945 crore rupees in FY21. According to experts, with many IPOs of new age companies not performing well, SEBI has now tightened IPO valuation scrutiny to protect retail investors from burning their fingers. They now need to get their non-financial metrics audited and explain the valuation.
Post the major crash of Paytm and questions raised on valuation metrics, SEBI had tightened IPO valuation scrutiny. The focus was basically to protect the retail investor from burning their fingers in these new age IPOs. The IPO bound companies have now to get their non-financial metrics, KPIs, that is the key performance indicators, audited and then explain how they are used to arrive at the IPO valuation.
Oyo's IPO has some other issues too. Arun Kejriwal of Kejriwal Research and Investment Services points out.
1/4 of the revenue comes from India and 3/4 of the revenue comes from overseas. Or in simple terms, for every rupee of revenue in India, the company has 3 rupees of revenue which comes from outside India. There would be questions on why does such a company need to register or list itself in India. It should go overseas, because that's where the bulk of the revenue is coming from.
Kejriwal also said that major hotel management businesses in India like Taj and Oberoi provide manpower and manage the resources of their partners. For that, they get a revenue share of 3 to 5%. Oyo, on the other hand, does not provide any such managerial services, and yet it charges a 25 to 30% share in the revenue. Analysts are worried it would diminish the valuation post-listing. The company is caught in several legal disputes too.
Secondly, if you notice what's happened in this particular issue, is there are multiple cases which have been filed against the management of Oyo in various courts, high courts, etc., all across the country, where there are disputes between revenue sharing, there are disputes of various kinds. One case was settled recently where Oyo had not allowed the listing of hotels or properties of a particular group to come onto the company. That case has been settled, and Oyo had to dish out in excess of 200 crores. Now, when would these cases get resolved? Your guess is as good as mine. But with so many cases on the core business model of a company being under dispute, definitely makes an investor or prospective investor very, very worried about the business that he is going to invest in.
So, what valuation can Oyo expect?
Oyo seems to have reported a minor EBITDA, a positive for Q1 FY23, but that seems to be on the back of major cut in manpower costs, as the growth on the top line doesn't seem too impressive looking at the way the industry has bounced back. So I believe Oyo would be looking at a valuation between about $4 to $7 billion, but may still be finding it difficult to justify.
The financials of the company, particularly EBITDA, seems to be improving, but the management of the company might need to address the issues of the investors to keep Oyo's IPO a safe bet for investors.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.